Hello, everybody. This is Beast McFeast, and we're going to go over basics of why investing is important. So, in general, people invest to achieve various things. Their investments might be in the markets, the stock markets, or in real estate or collectibles, whatever you want to invest in. You're trying to achieve basically the same thing. You want to work for fewer years or buy something like a house. You want to retire better, maintain your quality of life in retirement. You definitely want to beat inflation, and you need to put your money to work. I think a lot of people have seen in recent years that some people retiring did not maintain their quality of life, so they worked their entire lives and saw a sharp decline in their quality of life in retirement because they didn't invest and they relied on Social Security, which honestly is not the greatest. I'm, in my 30s and I don't anticipate Social Security funding most of my retirement. I don't know if it'll be around or not. So I'm having to assume it's not and do it myself. We definitely need to beat inflation. It's 2022 and the inflation numbers are looking at like 7.5% over the last year. And what that means is your dollar buys less, significantly less. And the 7.5% indicates that it's quite high, a couple times over the target number. And finally, we want to talk about, putting your money to work. What does that look like? And why is it important to start early? I think a lot of people think that they'll do this later in life and they lose out on the time value of money. Dollar invested now is worth more than a dollar invested 2 years from now or 3 years from now. So we'll talk briefly about like what it looks like if you start early and what happens if you start later. Why are we worrying about inflation? Well, as I said, it's a reduction of buying power. And clients come to me and sometimes they say, I want X number of dollars in the bank. And that's not really like what we're trying to do to prepare for retirement. We're trying to maintain or grow buying power into retirement. So we have to beat inflation and then grow the person's account beyond that. In some years, it's easier than others. So this year, with inflation being high, it's a little more difficult. Last year, inflation was a little bit lower and the markets were just absolutely on fire. So it was really easy to do that. And when you take like your actual market gains and you subtract inflation, you end up with your like real net return number. That's kind of an important thing to keep in mind. I mean, if you're losing buying power at a rate of 7% a year and you're all in on 10-year bonds gaining 2.5%, you're not really gaining anything. You're just slowly losing buying power. Similarly, high yield savings accounts return like 0.5%. That's not really great either. So you have to look for actual investments to beat the inflation, whether it be real estate, collectibles, or the markets. I'm huge into equities. I favor them. That's what most of my content will be about. So the Federal Reserve strives to maintain about a 2% rate of inflation. And for the most part, they do okay. There's been some interesting monetary policy in response to COVID. So 2020 and 2021, interest rates were really low. Money was cheap. And because money was cheap, essentially a lot of it got created in the forms of debts. So loans were issued at a low cost and people were taking them and businesses were taking them. It was a smart thing to do if you wanted to get access to capital cheaply. For better or for worse, that sort of has led to inflation. And, the tools we have to beat that are raising interest rates. So that's going to be happening in the next few years. And in a very real way, inflation is like lighting your money on fire because every year it ticks away and it compounds in reducing your buying power. So you're going to have to find a way to beat it. I talk about some methods on this channel. There are definitely other methods out there. I'm not knowledgeable enough in the real estate space to, offer any advice on that. But feel free to go and look at that. There are some interesting ways to go about it. Some of them are high risk. Some of them involve tremendous amount of leverage, and I might stay away from those until you know what you're doing. But that is a good place to sort of fight inflation. Keep in mind, if you're doing it with the main, like your primary residence, you don't have access to those funds easily. That equity is locked up. But we need to put our money to work for us simply because, you're only going to make so many dollars per hour. And chances are that a lot of people's annual raises and bonuses are barely keeping up with inflation. On good years, we model out at work for our clients like 4 to 3%. bonuses and growth of income from their wages. And that's what a lot of people experience. Some years they get less, some years they get none, some years they get a promotion, and hopefully that promotion pays significantly more. That's not even a guarantee. What we need to do is take the money we have and grow it, preferably while we're not actively managing it. We want to put it places where it's going to grow on its own. So let's talk about what putting your money to work for you passively could look like. So let's say that, you take your entire working life, which is going to come out to roughly 45 years, is a rather depressing thought. And every year you put in $2,000. And what we're looking at here is this dark blue is how much you're putting in. It's a pretty steady line up. And what we've modeled is a 6% annual return, a 6% yearly return on your investment. I picked that number because that's closer to what people experience, even though the markets do better, like on average the 8 to 9 to 10% area if you follow the S&P 500. But the IRS is going to take their cut. If you have it actively managed, there's going to be fees. So a lot of people walk away with 6% yearly gain after fees. It's not incredible. We'd like to have a little more, but it's hard to do that without a lot of risk. Maybe here, earlier on in life, I'd take more risk and try to steepen this curve a bit. But for this model, we're sticking with 6%. And as you see, the actual return, the light blue, grows in an exponential way. It increases more sharply. Now, let's say that you're in your 20s and you cannot find a way to save $2,000 a year. We don't cut off the first years. No, we're actually going to cut off the last 10 years. What you'll experience is, instead of ending with 1.3 million, you're going to end with, over $500,000, but below 750,000. And it's because the money here has all this time to work. Your first 2,000 has all this time to work. And if you're talking about 6% gain per year, that first 2,000 is going to double roughly every 12 years. So it would be doubled here, double again, and double again. And all the money that comes in behind it is going to do that. And that's how you end up with this very steep curve at the end. So we need to achieve this. And I try to convince people to start early. A lot of people don't want to do that. And I'm for enjoying your 20s and 30s. I'm also for paying the future you. Not an exorbitant amount, just enough to get you where you want to go. And $2,000 a year is not a big ask. So where do we want to put our money to work? I have a strong preference to stocks. Lately, I've been staying away from bonds. Crypto is definitely a curious thing. Real estate, I think I'd be a buy and hold real estate investor where I'd comfortable acquiring a property in the future to rent out. I'm not looking to do like B&B arbitrage or Airbnb arbitrage. A lot of people are doing long-term rentals and then renting out at a daily rate against that. And that's kind of a high-risk play with very high rewards when it works out. And that just doesn't fit what I'd like to do in terms of my risk tolerance. Now, I take some pretty stupid risks in stocks sometimes. I have a smaller trading account, and I do some dumb things. But overall, I invest in pretty reasonable mutual funds, ETFs. I also do private equity and buy into friends' businesses. If you know people, or even if you don't know people, there's ways to go and meet people who want investors for their business. And sometimes that will show you the greatest rate of return. It often, when it works, private equity will outpace real estate, crypto, bonds, and stuff. The only issue is sometimes you're on the hook for losses, depending on how the deal is structured. And again, it's very risky. And finally, collectibles. It's hard to predict what collectibles are going to be worthwhile. I mean, baseball cards were looked at as collectibles in the 80s and 90s. Beanie Babies came around in the 90s, I believe. And, no one was able to predict what would be collectible and what wouldn't be. I mean, there were things I threw away from childhood that would have been nice to have now in good quality because they would have been awesome collectibles. Lately, a weird one I've heard about is people saving nice Lego sets that are limited run Lego sets and selling them for 2 to 3 times as much in the next 4 and 5 years. And that's awesome. I don't know if anybody is doing that on a large enough scale to fund their retirement. But, well, it's probably not going to hurt if you don't overspend early on to do it. So go ahead and check out my other videos here. I've got 2 of them, and they're pretty good. I like them. Feel free to like and subscribe, and leave a question or comment in the appropriate section. Thanks. Bye.